Guys, markets are soaring because CPI came in better than expected. This is the chart back here for core inflation as well as CPI. We'll get into that in 2 seconds, but markets are up big, and now the markets are factoring in 2 rate cuts for 2024, which is a lot different than 5 months ago where they're factoring in 6 or 7. Now, before I go further, if you're new to the channel, if you like getting 4 or 5 videos per week, reacting to the markets, to the economy, anything like that, we're here for you. We release the videos quickly. Do me a favor, subscribe. Make sure you hit the notification bell so you're told when the videos come out. This channel is growing like crazy because people like the immediate reactions to the markets. Now, there were expectations of a 0.4% increase in prices, but the CPI only came in 0.3% higher, which was lower. Now, remember, the Fed's goal is core inflation. That excludes food and energy because they're very volatile. If you look right here, core CPI is at 3.6% versus the goal of 2%. Now, we've seen Fed Powell last week come out and kind of hem and haw about the 2%. Is it realistic? Is it not realistic? He's been talking about that a lot lately, but he's staying true to his word of saying, listen, I don't see this immediate decrease, this consistent decrease down to 2%. I need to see that before I start cutting rates. What I've always said on this channel is, why would they cut rates unless they need to stimulate the economy? And why do you need to stimulate the economy that already has very low unemployment and good economic growth? The only reason you do it is if there's recessionary things happening. So when I hear people getting excited for rate cuts, I'm like, you realize rate cuts would probably come on the tail end of some sort of recession and some sort of fear of that. Maybe it might be different this time. I'm actually considering that. Like maybe they would just cut rates to get people back to normal because we rose rates so fast. We had 0% 2 years ago. Now we're at 5.25 to 5.5. I used to get 0. There was actually at one point, 90-day treasuries were slightly negative on their interest rates, which means if you gave the government $10,000, they gave you a little bit less money back 90 days later. That's incredible. Now, that same rate is 5.4%. And for investors out there, this is wonderful. This lets you be more picky on the investments you make. This tells you, hey, listen, why should I go make an investment to make 7 or 8%? I can put it in 90-day treasuries making 5.4%. So this high quote unquote inflation, which by the way, you know what historical inflation is? 3.5%. So we're not far up. We're basically there right now. Now, one concern going forward, PPI, the producer price index came in higher than expected at 0.4%. Producer price index tends to be a leading indicator for consumers. Why? This is what it costs producers to make their goods and services. If it's coming in higher, it's going to take a little bit of time to push those higher costs onto consumers. So this is not to be a fudster. It's just saying, guys, don't be surprised if future CPI comes in a little bit higher. I'm not saying it will. I'm just saying producer price did come in a little bit higher than expected, which means the immediate future might be a little bit worse on the pricing index front. But remember, guys, what we're trying to do on this channel is teach a process, what's called a bottoms-up process. Picking good companies at good prices and not worrying where the economy is going. There are tens of thousands, probably hundreds of thousands of data points in the economy. You can't possibly worry about those. What your goal is to find great companies at good prices. I believe great companies at great prices. But obviously, that great price is very subjective. You need to find good companies with good balance sheets. Because remember, a company with a lot of balance sheet, with a lot of debt in their balance sheet, rates going from 0 to 5.4, when those loans come due and they need to start refinancing that, their profit is going to plummet. A company with a lot of debt like AT&T, what are they going to do when $200 billion of debt comes due in the next 2 to 5 years? And the rates go from 3% to 7% for them. That's 4% on 200. That's a lot of money. Now, a lot of great companies like the Magnificent Seven have great balance sheets with not a lot of debt. They can easily afford these jumps. They don't care. Heck, they can just write a check and get it over and done with. That's what we're trying to sit there and accomplish here. We're trying to teach the bottoms-up approach of looking at the company and not worrying about the economy. Guys, I fell for the same thing years ago. I used to sit there and where's the economy? And I realized how dumb that was. Luckily, it took me not making as much money to be able to understand that I missed out on a lot because I was always worried about the economy and where it was going. I'm done with that. It might take some time, but that's the point of investing. Investing is about learning these lessons and having the emotional grind weigh on you. Some people will choose to have that emotional grind and push it aside and avoid it forever. Not me, and I'm hoping not you. The fact that you're watching this channel tells me you're trying to learn, trying to get better. I love talking about the economy. I love talking about inflation. I love talking about these things, but it does not affect the way in which I invest. What I do to determine if I buy a company or not is price versus value. Every investment's the present value of all future cash flows, and I use the fundamentals in our tools to sit there and determine, based on my assumptions about the future, if the price is lower than the value today. We don't want to buy when price is above value. We want to buy when price is well below value, giving ourselves a margin of safety. Now, that's easy. That's the easy part. I know it sounds crazy because it's the future and it's unknown, but that's the easy part. The hard part is the emotional side. When you start seeing unemployment go from 3.8% to 4.2% to 5% to 7%, all of a sudden you have a recession going, oh my God, the world's falling apart. We'll be the channel who tells you the world is not falling apart. Be calm. We will be the community that does that. In our community up here, we have amazing people who root on for worse times. Why? They want lower prices. They love it when days are red. Do you love it when days are red? In all likelihood, you're going to say no. We don't like losing money, but the right investor loves seeing prices lower. Yes, they might take a hit on their current investments, but it's an opportunity for them to buy great companies at even better prices. We've all made terrible emotional decisions that cost us money. And you're going to continue to do that. The goal is to decrease those emotions. So if you're interested in decreasing your emotional decisions that cost you money, click the link below, $7 for 7 days. Join this community. There's a limited number of spots every day, so jump on it before the spots run out. Because if you get on the wait list, you might have to wait a little bit. We will send you an email to fast track you, but the spots are limited to start the day, so make sure you get in as soon as possible. Now, another interesting tidbit that came out last week. Household debt is skyrocketing. Now, guys, this to me is futster material, and here's why. Here's the actual debt levels. Yes, we're at $17.69 trillion in household debt, and that's an all-time high. Newsflash, U.S. population's bigger, GDP is bigger, incomes are higher. We're going to have higher U.S. household debt. That stat in and of itself means absolutely nothing. Absolutely nothing. And this is my beef with the media. They sit there and say, oh my God, look how terrible this is. Well, did they mention that U.S. income is at highest levels ever? They don't mention that. Did they mention that U.S. GDP is at highest levels ever? They don't mention that. What I want to do is compare U.S. total GDP to the household debt. Looking at that ratio, looking back at it, total household debt only goes back to 1999. So going back to, we are currently at $17.69 trillion in household debt compared to $28.3 trillion in US GDP. That's 62.5%. Our average going back to 1999 is 68.5%. Are you hearing that in the media? That we're actually below our 25-year average? Below. Can I repeat that? We are below the 25-year average. But you don't hear that. You just hear, and by the way, guys, I'm not saying that all this household debt's okay. Nowhere am I saying that. I'm just saying let's keep it relative. Now, I'd love to see household debt going back 60 or 70 years because the 80s is when debt really started to pick up the pace. We started to become this economy driven even more by consumers, even more by debt. So I get that, and that I don't like. You've heard me in other videos say, whenever you borrow, you're taking away from future growth. But we have to keep it in perspective here. As an example, let's say tomorrow, U.S. household debt went to 20 trillion. The news flash would be, oh my God, U.S. household debt went up almost 20%. But what if also GDP went to 50 trillion? That percentage is going to be 60%. Sorry, not even 40% versus 62.5 today versus 68.5% average. Guys, you gotta keep it in perspective. Tidbits of information mean nothing without in relation to something else. Now, the other metric I want to look at is population's gone up. So I want to see what is this total U.S. household debt into the number of households we have versus GDP into the number of households we have. That's the important metric to look at. Let me see if I can find that real quick. Now, for the data on actually per household, now I think you should be a little worried. What I did was I actually took the data per household and did the ratios. Trust me on the numbers here, but basically what I did was I divided the total household debt by the number of households and the total GDP by the number of households and compared that number. Here's what occurred. The average, and I skipped a lot of years in between, but the average was about 62%, and we're currently at 62.6%. So it's a little bit above the average, but again, it's nothing to be completely alarmed about if you're looking at comparing the right data to the right data. Let me give you another example. I hear a lot of people on Twitter saying, oh my God, look at the prices from 1980 to now. Houses are up 7 or 8 times or whatever the number is, and income's only up 40%. What they're doing is they're comparing inflation-adjusted income to non-inflation-adjusted home prices. That's completely misleading, and it drives me up the wall, and it happens all the time. So you have to be able to compare data accurately. Don't look at inflation adjusted compared to non-inflation adjusted. The point I'm trying to make is, do I like higher household debt? No, I don't. But is it as alarming as saying all-time high? Well, so is GDP. Look at GDP, all-time high, all-time high, all-time high, all-time high. You don't hear them saying every quarter all-time high GDP, do you? They should, because literally every quarter going back how far has been all-time high GDP. So you have to sit there and take things into perspective. All the more reason I'm asking that if you like hearing data and understanding a little bit more about the data, subscribe to the channel, hit the notification bell. That way you get these notifications. Again, I don't want you making major investment decisions. I still want you dollar cost averaging into low cost ETFs. And if you choose to buy individual stocks, focus on buying good companies at good prices, companies that you want to own for decades to come. So guys, if you want to see the other most recent news we react to, watch this next video. You'll see our last video. Thank you very much for your time.